What's up, Resource Nation? We got another special for you here today. What the heck's going on? I don't know. Rates are up, then they're down, then they're back up. Nobody can find a house to buy. And when they do, there's a bidding war. I jumped into Clubhouse the other day with Logan, and he dropped some major knowledge. And then I reached out to him like, hey, Logan, can you come back on the show and help us figure out what the heck's going on today? So, Logan, once again, I think for the third time, welcome to our resource, and thanks for being on the show.
My pleasure to be here.
So let's start with Clubhouse. You know, rates are, like I said, rates are making a run. Nobody can seem to find a house, but you actually dropped some really good knowledge in that Clubhouse room, which I think was your first, right? Your very first Clubhouse.
Yeah, that was actually the first time I really talked.
Nobody knew, by the way. Like, you came in like a professional.
I just came in and I was actually just about to leave. I was just like,
yeah,
somebody coming in.
And then everybody started coming in because Logan was there. So it was awesome. And you said something. I'm sure going to butcher it, but I remember you talking about the economic indicators pointing to a really strong next 3 to 4 years for housing. Did I get that right?
Yeah, I mean, basically, housing is always a demographic story first. You know, people buy homes, right? And then mortgage rates are second, right? So one of the reasons why I wanted to focus on that the housing bubble boys or forbearance crash, these are some of the worst talented Americans ever in history, is that the two things that drive housing on a historical basis are at the best levels ever in history. And this is why I've always talked about, for many years, I've talked about this since like 2013, 14, or 15, that years 2020 to 2024 are going to be so different because that's the best housing demographic patch, and mortgage rates should be low. Now, of course, COVID came and drove rates lower than they would have been in a normal cycle. So here it is, the two best things, and look what's happened. I mean, if you just look at the basic raw 2020 data and now 2021, compare it to the previous expansion, everything looks fine, normal, great. You know, people are buying homes. People buy homes for shelter. We need a lot of people to buy homes because guess what? Ages 27 to 33 now are the biggest ever recorded in U.S. history. I always tell people, biggest ever recorded in history. There's 32.5 million of them, right? And they all don't buy homes at once, but shelter, right? Housing is the cost of shelter to your own capacity to own a debt. So millions and millions of Americans buy homes a year. We just have a little bit more of them. That's why I call it replacement buyers, right? We have a very healthy number of replacement buyers. Since 1996, we've rarely had existing home sales under 4 million on a monthly print. Even total home sales were about 4 million in the worst years of 2008. But now we just got a little bit more, and mortgage rates are lower. So the notion that home sales were going to go down 2 or 3 million, it's crazy talk. And mortgage rates
went up,
low.
Logan. The sky's falling. Like, what the heck?
Yeah.
Is the party over?
You know what's interesting? The entire AB economic model that I wrote for HousingWire.
So that's, guys that haven't read it, you should go read it. We'll put all the links. It's called America is Back. That's what he's referencing.
Yeah. And a lot of it was the 10-year yield's going to rise. You know, by the end of 2020, we should get to 1% on the 10-year yield. We got to 99 basis points on that. But the main thing, the entire model was based on the 10-year yield should be between 1.33 to 1.60, right? That's where the 10-year yield should go because we're out of a recession and bond yields should be there. So when the 10-year yield got to 1.33, I was hip, hip, hooray. Guess what? 160 is next, guys. Guess what happened? Within a few days, bond market went to 160. People bought them in because bond traders are very predictable. Yields came back down. So we're just going to be running around back and forth here. And, you know, the call for 2021 was 3.375, maybe 3.625, something in that level. Completely fine, right? It's just not. And I would argue that this is very healthy because the most unhealthy thing is that housing is too hot. Demand is too good. Inventory is too low. So the biggest concern I had in years 2020 to 2024 was that home prices could accelerate above my 4.6% nominal basis, where we go above there, real home prices go up. It's just not healthy. And that's what's happening. You know, you take the Case-Shiller index, we're like 10.4% on an annual growth, not healthy. So we want higher rates. It's not healthy for anybody to have these multiple bidding wars because inventory is at an all-time low. Demographics are the best ever in history and mortgage rates are low. So hopefully, this is what I'm thinking, is that rates slowly go up, just cools the market a little bit down so people don't have to like panic and go, oh my God, I can't sell my house because there's nothing out there I don't like. I'm just going to wait. We just want a more stable, normal market. This is way too hot.
So is this kind of orchestrated? This might be a dumb question. Forgive me if it is. I wanted to ask you in the clubhouse room, and Dan Rawich was on in another clubhouse room, and I wanted to ask him too. But we know the feds are the biggest purchasers of mortgage-backed securities. They have been. And I think you wrote an article saying like, the market actually needs higher rates, and you kind of just talked about why. Mm-hmm. So is this simply the Fed kind of taking off the pressure to keep rates low? Is that a dumb question?
This has nothing to do with the Fed, really. This is just basically economic growth. Now, go back to the previous expansion. When I started incorporating bond market forecasts into my prediction articles, I said the 10-year yield should just be in a range between 1.6 to 3%, right? Growth is inflation expectations. That's it. 3.5 to 4.75% mortgage rates. That's the trend. COVID was the one thing that took rates much lower than there should have been because it's an unnatural event. So when I talk about rates are artificially low, it's nothing to do with the Fed. It's just that we have this plague that's preventing the U.S. economy from working at full capacity. So the recession's over. The recession is over. So basically everything's fine. 10-year yields should move up. Rates should move up. Nothing with the Fed. It's just economics.
So you made a bold statement in the clubhouse room, and you've made it several times. And you talked about the recession's over, and I love listening and reading your stuff because sometimes it's contrarian to what a lot of other analysts will say. Which, by the way, I didn't do a great introduction. He's a lead analyst for HousingWire. He has a great website as well. Which again, we'll put all these links below. But you said inflation's not a thing. Which in fact, if you pull up CNBC right now, there'll be a headline with this inflation.
Let me be really frank here. The inflation people in America are the worst talented people ever in our history.
Explain.
We just had 20 years of people screaming about inflation, and we couldn't even get core PCE above 2.5%, right? These are fraudulent grifters. Like, you just look at the data. People have been talking about hyperinflation for many decades. Bond yields have been falling for 4 decades. Rate of growth has been falling. It's just a bunch of podcast stock trailers, anti-central bank gold bug people crying like they always do. Most of them are baby boomers. Their time has come. This is why I actually like to see the Bitcoin people kind of make fun of them. It's a fraudulent grifting tactic, right? Inflation is just not the thing. People say, well, our debt to GDP is very high. Japan's debt to GDP is 250%. We can never catch up to them, and they're borrowing at negative rates and inflation is low. Demographics are deflationary. Technology is deflationary. You're going to see, one of the things I've done on Twitter is talk about, we're going to have really high inflation data in terms of taking the lowest end of prices and the higher ends of prices. And guess what? People are going to think hyperinflation is going to come. It's a production shortage, right? How much are we going to have a shortage of goods, right? Not really. Production level will eventually moderate. We're going to have a little boost of inflation, and then it's going to come back down. And then we're going to do this every decade for every year this century, and people are going to scream inflation. It's not going to be the thing that people want.
Love it. So in general, again, our audience, mortgage guys, gals, and realtors, a lot of consumers as well, you're saying, hey, let's not freak out. I think we got a pretty good, strong road ahead for at least the next 4 years. We're actually in a pretty good spot, even though rates jumped up. But like in perspective, like we're right back to where we were kind of right before the whole refi boom started. I just looked at it today. If you pull it back a year exactly, we're kind of right back there, and it's still a really good rate environment.
Here's the thing. If 5% mortgage rates didn't crash the housing market in 2018 for the existing home sales market, how is 3.25% going to do it?
Yeah, not at all.
I mean, and in 2018 wasn't even the demographic patch that I'm talking about, right? So look at forward-looking economic indicators. It's basically purchase application data. Purchase application data is doing much stronger than I even thought, right? I thought about a 1 to 11% year-over-year growth. We're trending really, if I take the first week of January away and then the Texas snowstorm holiday week, we're running at 15, 16% year-over-year. This is why I talk about housing is way too hot right now, right? Inventory is too low. We have too many bidding wars, but the forward indicators are still fine. Now, one thing everyone's got to remember, COVID has messed up all the data lines. So after March 18th, we're going to have really extreme year-over-year growth data. That's due to the COVID low. And then in the second half of 2021, purchase application data is going to show some negative year-over-year data because it was too hot because COVID, we're doing the rebound in purchase application data. We're going to have some negative just because the 25% growth year over year is not normal. So housing, the front end, the leading economic indicators for the housing data looks fine. There's nothing here. Millions and millions of people buy homes. We just have a lot of them right now. And if you think 3.25 is going to crash the market, sorry,
No, I mean, I don't think
yeah.
anybody does. I mean, it'd be crazy if they thought that. I think it's just so hard to get a home. I mean, everybody's looking for a move up or their next.
This is the number one concern I have, because it isn't just demographics and mortgage rates being low. Housing tenure, people are just staying in their homes longer. I know a lot of people. You know, one of the worst housing takes of last year was that, oh, housing's booming because people are leaving the cities and no, people always leave the cities every year. People move up, move down, but this notion that the entire market was based on 3 or 4 cities in America, no, come on. People move up, people move down, people buy homes. There's investors, there's everything. But generally speaking, from 1985 to 2007, housing tenure was running at 5 years. We're at 10 years now. Hopefully, what I'm thinking is, because ages 30 to 39 are the biggest right now, this decade, compared to the last decade. People have kids. I always say people rent, they date, they get married. 3.5 years after marriage, they have kids. If they live near the city, they typically buy somewhere cheaper.
Right.
That's a good thing. You know, if the work from home model actually has some sticking power, people move to cheaper. That's a positive. All these things are positive. But right now, the market is way too hot, way unhealthy. In fact, I actually liked the 2019 housing market more than I like this, because you don't want 10% year over year price growth for 4 or 5 years. So high rates, positive. Just cool the market, get a stable things, kill this bidding war action, because we're not building enough homes to ever really infiltrate that.
Right. So let's wrap with one of your favorite topics, and you like to show how well you've done in the stock market. And I'm, like I told you I think our text the other night, I'm jealous. I don't know what to do, man. Bitcoin's up, GameStop's up, the market's up. It seems all, kind of manufactured to me. You're playing it perfectly. I am not. So in general, you also in the clubhouse, you said you feel like the stock market's due for a correction. Offline, I asked you how big, and you said possibly like a 10% correction.
Listen, if you go back in the last 10 years, having a 10% plus correction is very normal, right? We've had tons of them. We've had 2 near 20% actually corrections in the previous expansion. We haven't had a correction since March of 2020. So the longer this goes, it just builds it up. And I think that, to me, is a if you're looking for mortgage rates to go down short term or bond yields to rally, that would be your best thesis. Because not having I'm not talking about a 3 or 4 or 5% pullback. I'm talking a legitimate 10% plus correction. It hasn't happened in a while. So it's similar to what happened in 2017. 2017 was dead quiet for the entire year, and then 2018 came and we had like a 3 or 4 corrections in that year. So it'll come, that'll drive yields lower, mortgage rates will come a little bit lower, but the long-term story is that the US economy is early in its recovery expansion. Demographics are good, rates are good, inflation is low. I mean, the core PCE is 1.5%. All this talk about inflation, we can't even get to 2% PCE core inflation. And then what's happening is disposable income, DPI income is much higher now than it was pre-COVID. Also, savings rate is blowing up again. So I did a roaring 20s tweet like 7 months ago, and people are, "You're crazy." I said, watch the savings rate, watch income. When it's going to, we're about to open the economy up full force. And these people, oh no, it's economy's bad. We're going to, all this money and everything, people need to spend it, right? We're not savers, right? We're just hoarding our money because, some of the things we usually spend on, like travel or entertainment stuff, we can't do it. So in time, when we reopen the economy, remember, the whole thing is about the vaccine. Vaccine data every week is getting better and better and better. This is the worst news for the American bears, right? Their only hope they had is something terrible happened with the vaccine or some kind of other COVID strain or nothing. It's not happening. So we're going to reopen the economy. We're early in this recovery cycle. The recession ended last year, and we'll take it from there, right? So everybody be careful of these hyperinflation people, right? They're always doing the same thing year in year. No, it's just this is basically our modern day version of an economic cult.
So let's sneak in a bonus question, and I'll catch you off guard. But you talked about it in Clubhouse, so I know you're at least comfortable talking about it. So, realtors, lenders, you can click out because this is just overtime fun bonus question because we have Logan here. So in the Clubhouse, somebody asked you about Bitcoin, and I really liked your perspective on it. and he was talking about utilization and the fact that a very small percentage have Bitcoin. So, can you talk about it a little bit, just in our little bonus overtime here?
You're not gonna ask me if I think Russell Wilson's gonna get traded?
Well, I agree with you. I think he's going to the Saints, but what do you think?
Bitcoin, one of the things it's interesting. I don't really ever talk much about Bitcoin because the utilization, people don't use enough Bitcoin. So even when it went from like 17 to 3,000, it didn't really matter. Not a lot of people own Bitcoin. The one thing different that I've noticed about this time around is that they're not talking about mining Bitcoin or using Bitcoin to buy pizza or bubblegum or whatever. I think they figured this out. Like 4,000 people in the world own most of the Bitcoin. And I mean, I just don't know enough if they're even mining anymore out here. I think they've realized for the price to really go up, don't make any more, right? A few very people own the supply, and basically the price can go up in that sense. And I got some of that thinking just off of some of the tweets I see. I mean, I don't follow a lot of people on Twitter, but sometimes I see some people say, "Well, we're not making any more of it," or whatever. I think that is more of a clever way for them to talk about prices increasing. Like to me, it's just a financial asset, really. Low supply, a lot of money coming in drives the prices up. Outside of that, I don't really have a kind of an opinion, but I think they've learned, right? I think one of the things they've learned is that stop talking about buying pizza or bubblegum with it or making it a currency or whatever. Just talk about the price. It's just, right, it's people wanting to make money. And that's the way it goes. Low supply, a lot of money, low float drives the prices up. Sometimes you get these really big swings, but if the big holders aren't really selling, there you go.
I brought that back to my crew the next morning who we have healthy debates over Bitcoin. And I shared with them your perspective, which I like. I think it's really interesting, and it definitely sparked a debate. So they want to talk to you one-on-one.
I'm not a Bitcoin. The only reason I like some Bitcoin people because they make fun of gold bugs, right?
Yeah.
So it's like the enemy of my enemy is my friend in this case.
Well, I think Peter Schiff is trying to get Elon on a Clubhouse to kind of debate that, which I would love to listen in.
Yeah, Peter Schiff.
He's going to push his book. I mean, he's going to talk his book, right? Like, he's going to push gold.
The gold bugs. Listen, I honestly think this. I think these people just hate being alive after 1930. I always tell my gold bug friends, I said, as soon as I create a time machine, I will send you all back to the 1800s where you have these massive inflationary, deflationary collapses, panics around the world. So that's what you want. It's just being born past 1913, no matter what it is. The hatred of being alive in America this day drives these people insane.
God, I love that.
That's the only thing I like. Why are they crying every day about inflation, right? So it's past 1913. They would love America from 1803 to 1912. So.
If you stayed for overtime in the bonus, you were treated to that. That was amazing. Hey, we're gonna put all of Logan's stuff down below in the comment section. Follow him on HousingWire. He has his own website. There's a current article up right now that's really, really good. That America is back is on there. That's when we first brought him on last year.
And for HousingWire, next week we have the HousingWire Summit. Yeah, so it's a summit on Thursday. You have to register for it. Some of the top housing economists from Redfin, from First American, and from CoreLogic, and myself, we're all going to have a panel. Talk about the right time to have a housing panel. Next Thursday, it'll be a great event. A lot of different takes on what's going on a lot of different subjects, right? Migration, demographics, home prices, rates, everything. We'll try to get it all in there, all four of us. Yeah,
we'll put the registration as well down below. If you can find him on Clubhouse, follow him, jump into any room that he happens to jump into as well. Logan, again, thanks, man. And you didn't make your prediction. I said Russell's going to the Saints. What do you think?
I actually think he might go to the Raiders.
I'm okay. The other two, he said Jets and Bears, and I don't think that's a good fit.
The Saints make the most sense.
That's a Super Bowl run right there, in my opinion.
But Russell holds the cards. He has no trade clause, so eventually, this could be a gimmick on getting a good salary and maybe some offensive linemen to protect him.
Could be. All right, RE Source Nation. See you guys later. Thanks again, Logan.